time for Yahoo Finance's Market Minute. Stocks are mixed ahead of a busy week of earnings and economic data. Investors will be parsing these reports for signs that tariffs could be impacting the economy. Tesla is slightly lower after closing above its 50-day moving average on Friday. The move higher for Tesla started on Tuesday when CEO Elon Musk said he'll spend less time at Doge and more time at Tesla HQ starting in May. Market technician Chart Smarter saying the shares are at $300 are now in play for Tesla. And Domino's Pizza reporting mixed results in its first quarter revenue, narrowly missing while profit topped expectations. Pizza chain's international sales growth offsetting a decline in the U.S. And meantime, shares of WW International extending gains after surging over 160% on Friday. Investors excited after activist investor Galloway Capital disclosed a 3% stake in the business and sent a letter urging the company not to file for Chapter 11 bankruptcy. That's your Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. I'll talk to one wealth advisor who makes the case that the 60-40 portfolio allocation isn't working right now and offers another way to think about your investments. And Investing Playbook all week on Wealth, we'll dive into all things technology, how the sector fits in your portfolio, how to think about AI, and how to stock pick from the largest sector here. And on today's show, we'll also discuss your exposure to technology. Are you overexposed, or do you have just the right amount? Plus, in today's show, we also discuss understanding bond ladders here. We dive into the investment strategy that involves investing in CDs or bonds with different maturity dates in order to provide income while minimizing interest rate fluctuations. We've got all that and much more during today's show. Let's start things off as we always do, getting a check of the markets, taking a look at some of the market action here. 90 minutes into the trading day. We're mixed right now. You've got the NASDAQ down by about 0.3%, but holding on to green for the Dow and the S&P 500. We got a busy week of big tech earnings here. Joining me now, we've got Jim Carroll, Ballast Rock Private Wealth Senior Wealth Advisor and Portfolio Manager. You say that the typical 60-40 portfolio allocation is just not working right now. So what should investors be doing instead?
Good morning, Brad. It's great to be with you. We are seeing the 60-40 behave somewhat the way it did in 2022, and that's not very useful for investors. We have not believed the 60-40 was the right strategic asset allocation for a long time. There's a lot more available than simple stocks and bonds these days, and we have been building portfolios using some combination of traditional assets and ETFs, but also including things like buffered ETFs that protect on the downside and private market vehicles like private credit to build what we think are more resilient portfolios.
And so with that in mind, what is perhaps a different type of, we like general numbers, right? That's why 60-40 perhaps has done well for a while in that balancing, but also it's easy to remember. So what is the different type of perhaps percentage positioning that investors should be keeping in mind?
It obviously varies by investor, right? Younger people can take on more long-term risk than some of our older, closer to retirement or in retirement clients. But we think, 50-20, 50-25-25, or even a 60-20-20, something that gets less correlated investments in the portfolio. And that, again, could be a mix. We're taking some of our equity exposure and using buffered ETFs to give us protection on the downside while allowing participation in the upside. And then bringing in things like private equity secondaries, which we think have a tailwind, particularly with endowments like Harvard and Yale. Getting rid of some of their private equity exposure, that's going to wind up in the secondary markets, and we think there'll be some interesting opportunities.
Interesting. And so as we're thinking about what has transpired over the month of April, I mean, it has been a wild one for investors to track here. And in some of your notes here, really talking about Liberation Day and the tariff tantrum, a lot of investors are just trying to figure out what's next. Will there be, once we finally see some of the negotiations start to really solidify, any type of clarity around what a deal could look like on many different fronts for all of the countries that are impacted? And then additionally, how company fundamentals receive a little bit more clarity on the back half of that as well. What are you anticipating as the kind of what comes next critical moment here that investors are waiting for?
It's interesting because the tariff tantrum brought record-setting levels of volatility, both up and down. And just last week on Thursday, there was a lot of ink spilled in journalistic terms about a Zweig breadth thrust, which is a signal that perhaps the market has bottomed. And nothing would make us happier than to see stocks, go northeast from here. But we're concerned that the impact of the tariffs really hasn't been seen yet in earnings. There are a lot of signs to suggest that, if we're not in a recession, we're certainly going to see some recessionary outcomes from the tariffs. So we think it's a time to take a breath, not be overextended in the markets, let things play out a little while longer before we take any strong positions one direction or the other.
And so what is the kind of clarity point that investors should be keeping in mind, even as we're waiting for more details around that, and how they should be making sure that their portfolio doesn't have too much exposure to companies that could be hit hardest by some of the interim tariff negotiations?
It's interesting because one of the things that we've seen recently, and it really started before the tariff tantrum, was that global equities, Europe and certain parts of Asia, were beginning to outperform the US. So the other thing we're doing in our portfolios is shifting some of our equity exposure away from the US. It sounds counterintuitive. I talk to my friends in Europe and they say, you're crazy, you're out of your mind, things are terrible over here. But price is the ultimate arbiter, and we've seen outperformance in places like Europe, Latin America, Japan. So we're also shifting some of the equity tilt outside the United States.
Jim, good to see you. Thanks so much for taking the time here with us today.
I appreciate it, Brad. Thank you.
Now time for some of today's trending tickers. We're watching Peloton and Spotify. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Ali, first up, we got to talk a little Peloton. Getting an upgrade to buy from hold at Truist. This comes more than 3 years after the firm downgraded the stock. The analyst says that they believe the stock is finally nearing a point where improving fundamentals should support a gradual recovery in shares here. Those shares moving higher for Peloton by about 4.6% on this call.
Yeah, and some choice words here from the Truist analyst saying the BS has been cleared, and there's a few catalysts as to why. There is a new CEO. He took the helm in January 2025, and it looks like he is prepped to deliver on those profitability metrics. The company has been cleaning up its balance sheet through cost cuts. There's been several rounds of layoffs, along with reduced operating expenses, a reduction of debt, and really there's just a clear path forward when it comes to growth. So all of those are tailwinds for a company that's really just been going through it. Shares are down nearly 25% year to date. We're trading at just around $6.50 a share. Truist sees shares rising to $11, so upside of between 60 to 70%. I mean, the confidence there, especially for an analyst firm that has been sitting on the sidelines for the past 3 years, that definitely says something. And in terms of what the company can deliver in the future, there's potential catalysts when you think about subscription price increases, activation fees for used equipment, new offerings, and maybe potentially strategic partnerships with companies like Lululemon, Fitbit, Amazon. So really, shares have been de-risked according to this firm. But remember the heyday of Peloton? It just feels like we're never going to get back there. So what does that mean? What is the future of this company? Seems like there is a clear story, but does that mean it's fully going to ever return to that period of dominance? I don't think so.
Oh, well, I mean, the heyday, and you could argue the payday for Peloton was when it was really crazy. Dilemma days for the rest of us.
Right, it's all COVID related.
Exactly, yeah. It was one of the pandemic darlings, as it has widely been regarded within the market here, and that seen played out within its long-term chart as well. We're also watching this next name too. Investors have their eyes on Spotify ahead of its earnings release Tuesday. Wall Street's looking for an update on the music and podcast streamers' ad business, given some of the recent macro concerns here. Shares of Spot down by about 2.7% right now.
Yeah, there's a few things to watch out for. Let's start with that advertising revenue. Advertising revenue makes up about 12% of total revenue for Spotify. And sources have been telling me that advertising, it's first to go when you have a recessionary period. So any update on that is something to watch out for, especially for a company that's so reliant on its ad business. Investors also, they're going to care about the user metrics, as is always the case. For the first quarter, we are expecting gains, 2 million subscriber additions, 3 million monthly active users. Now, in recent quarters, margins have also been a big focus and a big driver in this recent run-up that we've seen in shares. Margins have just been quite stellar, but we could see a slight dip on a sequential basis due to new investments like video podcasting, expanded music offerings. That could weigh on second quarter guidance. And that's another thing to watch as we continue to really monitor the impact of this current volatile period. It feels like we're in a moment of transition for all of these companies, because we're not going to see a ton of impact in these first quarter results, but it's going to be a lot of what they expect in the quarters to come, and whether or not we could see some of these macro concerns weigh on these companies' bottom lines.
Yeah, services and streaming services, typically one of those last kind of things that consumers will cut, but we'll see how they're looking through the consumer.
Right, and Spotify is relatively cheap. They did recently raise prices. We could see more price hikes, and that would be a catalyst for this stock. And there seems to be a lot of room here for a company like Spotify to raise prices. I mean, personally, for me, I'm not getting rid of it. I will probably keep paying it. And that's really key, is how sticky are your prices. And Spotify, it's not that expensive right now, but if you combo that with potentially a squeezed consumer, what could that say?
Price hikes.
Yeah, price hikes. You know, we'll see. Daniel Ek is very cautious about price hikes.
Yeah.
He likes to listen to the consumer, and considering we're in this time where we have this weak sentiment data, weak survey data, maybe he'll take a beat there.
I hate those price hikes for you,
I know.
Allie. As you know, I subscribe to a different service.
Even if it's $1 or $2, it's a lot.
Yeah, that's true. Thanks so much, Allie. Appreciate it. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, your tech investing playbook. We kick off a big week of tech earnings with some strategies for your portfolio. Stay tuned. Stocks are under pressure overall in 2025, but the technology sector is actually underperforming the broader market. The XLK is down more than 10% so far this year. We have a number of technology companies reporting earnings this week, like Microsoft, Apple, Amazon, Snap, and Meta. So we want to guide viewers through a tech investing playbook. Joining me now, we've got Ivana Delevska, who is the founder and chief investment officer of Spear Invest. Ivana, great to have you here with us in the studio.
Thanks for having me, Brett.
Absolutely. Let's walk through this. Technology, we know, represents more than 80% of your portfolio. What is your base case for that heavy weighting, and is that style of investing for everyone?
Well, those are great questions, Brett. So on one hand, the way we find our investments is by analyzing entire value chains. So we, for example, AI is a topical theme, right? So we will analyze the hardware layer, the software layer, the application layer, and this is how we find where the changes are occurring and where the opportunities are. So we end up having a lot in the technology space because there is a lot of changes happening there, right? We're sector agnostic though, so it just happens so that the largest opportunities are in the tech space, especially for long-term investors. And then to your second question, technology, and specifically what we do, is really biased towards long-term investing. So you don't want to be trading, you don't want to be investing with a short-term horizon. Right. You really need to have the opportunity to add on pullbacks like this year.
And so what is kind of a safe rule of thumb that everyone should be keeping in mind, investors keeping in mind, about their technology exposure when it comes to their portfolio?
So if you're a long-term, long-only investor, you want to be calculating in your base case scenario that your stocks can be down 15 to 20% on a regular pullback, and as much as 45% on a recession worry or a more prolonged pullback. So those are the types of metrics that you want to be expecting, and not being able to withstand those and not having to sell on those types of pullbacks.
There's so many different industries within the broader technology sector here, and ways that investors think about the technology sector, whether their mind immediately goes towards artificial intelligence or if it goes towards social media companies. How are you looking across some of the advantages that even in an environment like this, volatile as it may be, that technology can hold for longer term investors, and some of the core themes that are best positioned?
So what we do, Brad, is really fundamental investing, which gives us a lot of confidence on pullbacks like this. So the way we identify the ideas usually have very significant valuation angle to it. So we have pretty strict limits of where we think the stock can go as low as, and where we would be adding to the position. So it's really all about finding the right kind of setup in terms of upside and downside in the opportunities. And then in terms of subsectors, we specialize in B2B tech. We think this is going to be the next layer or the next wave of the technology wave. If you look at the past tech cycle, it was really driven a lot by consumer companies like social media.
Yeah.
I think the next wave is going to be a lot more biased towards B2B. And basically the kind of guts of the technology trade. So whether you look at the hardware or the software infrastructure, and even the applications themselves are going to be much more weighted towards B2B.
As you assess the B2B landscape within technology, who are the strongest players that are standing out right now?
So we still like the hardware data center trade. Okay. NVIDIA is one of our top positions, but we like some of the other players as well on this pullback, like Marvell and Astera Labs. So we look kind of a tangential place in the networking and the power generation space is another one that we really like as well. Not necessarily directly in technology, but goes back to that value chain approach that I previously mentioned. In the application layer, we like Tesla as a play. We think robotaxis is going to be one of the bigger applications that will come out of this AI wave, and we think they're really well positioned to benefit.
Tesla is a technology company and not a vehicle or automotive company. Break down your thesis around that and why investors, because this has been a hot topic of debate. Do you think about them as a Ford or a GM, or do you think about them as a technology company because of the artificial intelligence embedded within it, or essentially that it's a computer on wheels that it's commonly been referred to as?
So Brad, over the past 10 years, we would have viewed Tesla as much more of an automotive play, and we would compete much more similar to the way the auto companies are trading, obviously with much higher growth expectations, right? Because EVs were hot and they were able to grow their vehicles at a much higher rate than the traditional automakers, but still an auto company. The FSD component of it was really more a feature. So you would pay extra for it, but really not a game changer in our opinion. Robotaxis, on the other hand, are a completely different game, right? It's a different business model. You're not selling to the consumer, you're operating fleets. And I think that's going to be where the value is going to be, especially on the cost saving side, as consumers get even more cautious on the cost to own a vehicle with tariffs and whatnot. So we think that robotaxis are going to be very well positioned.
Just lastly, while we have you, the difference between growth and technology in your portfolio as you're kind of assessing opportunities in this market?
So growth versus value, it's an interesting term that people use in different ways in different firms. On the hedge fund side, which is where I come from, it's usually a risk factor. So we would label stocks as value versus growth, or we would usually use momentum versus value. So those would be risk factors that we monitor. We want to be long momentum, usually for long-term investing. That's proven to be a successful strategy. So we wouldn't necessarily try to be like neutral on growth versus value. So we're okay having both components in our portfolio, but we are aware of what part of the portfolio is momentum versus value.
Ivana, great to have you here in studio with us.
Great to see you, Brett.
Thanks. Coming up, could bond ladders be the right investment tool for you? I speak to an expert about what they are and how they can fit into an investor strategy. That's next on Wealth. Let's get a check of the markets here as we are 2 hours roughly into today's trading activity. You've got the major averages actually all in negative territory as of right now. Let's put this on an intraday move so you can actually see what's been transpiring over the course of today's session. And it's not like we were ripping to the upside to begin the day, but we were in positive territory for much of the morning until this point here, midway through the 11 a.m. hour for the Dow Jones Industrial Average. The NASDAQ Composite, that had already touched negative territory pretty much out the gate. Some hyper oscillation that we were tracking here, but now solidly in the red, down 1.2%. We'll round that off to. And the S&P 500, same there, some waffling, trying to make up its mind, but ultimately now fractional declines here that are starting to accelerate for the NASDAQ, or for the S&P 500, as well as for the NASDAQ as well. Speaking of the S&P 500, let's take a look at the 11 sectors in the S&P 500 right now. We are still split. Utilities leading the pack. That's up by about 0.3% right now. However, pulling up the caboose, you've got technology, XLK, that's down by about 1.25%. Take a look at that year-to-date move as well that we've been tracking within XLK, one of the underperformers within this market. It's down by about 11.5% here over the course of 2025 thus far. Also taking a look deeper at some of those tech names here. For the NASDAQ 100, NVIDIA is your biggest decliner during today's, well, not your biggest decliner during today's activity here. You've got some others that are also, actually, it might be our biggest decliner. Let me just put this on an equal market view. Yeah, it is our biggest decliner right there with Tesla and Strategy as well, formerly known as MicroStrategy. You're seeing that also with Micron and Palantir pulling up the Lake Red caboose, or the Maroon 5, if you will, as we're making up those big laggards here on the day for the NASDAQ 100. However, leading the pack, you've got Gilead Sciences. That's up by about 1.5% here. Let's also take a look just briefly at the 30 Dow components here. Again, NVIDIA, the biggest laggard there, but looks like the biggest gainer is actually Boeing Aviation here during today's session. 2 hours into activity, we're up by about 2% there. Well, switching gears. With tariff uncertainty seemingly here to stay, investors are bracing for continued market volatility. For those near or already in retirement, this can be tricky to navigate. Could a strategy called bond ladders be a tactic to preserve wealth in uncertain times? Joining me now on this, we've got Liz Miller. She is the founder and president of Summit Place Financial Advisors. Liz, I want to start by saying welcome back to the show, and also perhaps we can start by explaining what bond ladders actually are.
Absolutely. And it's a great question in this environment. So, excuse me, a bond ladder is an investing strategy in fixed income. And the idea is that you buy bonds that mature at regular intervals that get longer and longer, hence going up a ladder or building a ladder. So as one matures, you buy another one on top of the ladder further out. And it's a great strategy when someone needs some assured regular cash flows.
And so you started to actually break into that. When do you know why or how to use a bond ladder?
Well, for retirees, bond ladders are a really great way to allocate their portfolio if they know they have the funds available. You know, as they do their analysis, as they work on a financial plan, they see that they have enough funds to provide the cash flow they're going to need. And when that's the case, a bond ladder can help sort of set it and forget it. A bond ladder set every month, every 3 months, every year can meet known cash flow needs. So we have some clients that will create a bond ladder for taxes. So we have a bond that comes due March 31st every year, so they know they have the liquidity, the cash available if they're going to have to pay taxes.
And so what about right now? Is now a good time to use bond ladders as you're kind of assessing the market environment?
Well, I like to say that if you're a retiree with regular cash flow needs, a bond ladder is always a good idea because it just takes the stress away and you know you're going to have cash as you need it. When we think about overall investing strategies in the bond market, a bond ladder is best when you know interest rates are probably going to go up because every time one matures, you buy the new one at a higher interest rate. Right now, we're in a stable environment, but we know that the long-term trend is we think rates will go down. So for our retirees that don't have a regular need of that cash flow, we're using a strategy that's sometimes called more of a barbell, where we have short-term bonds that are taking advantage of current interest rates, and we're locking in some longer-term bonds, 7 to 10 years, 12 years for younger clients, where rates have just popped up recently, and we can know that we can lock in for them very attractive rates, close to 4% for many years to come.
So what is the suggested ladder allocation given current rates and kind of looking through how current rates can impact someone's portfolio?
So for a new retiree, the first thing you need to think about is, well, what are your cash flow needs? We like to make sure that people have at least 3 months of living expenses. So maybe what we would do is sort of create two ladders. Maybe we'd first create a ladder that is short-term CDs or short-term treasury bonds that come due every 3 months, and make sure we have that liquidity for like the next 3 years. And then we would do a longer-term ladder where we would say, now let's start buying annual bonds, a bond that matures in 26, 27, 28, to keep supplementing those short-term bonds or CDs that give the retiree the cash they need to live on.
It seems like this is a mechanism, especially if you're just trying to preserve wealth, that would help you kind of lock that in. Is that a correct assessment?
Absolutely. But if we were talking 4 or 5 years ago, I probably wouldn't be talking bond ladders with my clients, because when interest rates were at 0, 1%, we needed to make more money than that to live on. Very few people were going to be able to fund their retirement in that environment. But today, where we have 4%, there's a very good chance over the long run we stay ahead of inflation, and we have a nice way to assure that we don't have to worry about where the next cash withdrawal is coming from.
Very key. Liz, thanks so much for joining us once again.
Thank you.
Coming up, investing in Bitcoin. We've got everything that you need to know about buying cryptocurrency amid market volatility. That's next on Wealth. Investors poured more than $3 trillion into Bitcoin ETFs last week, the asset's first full week of net inflows since March, according to Farside data. April has been volatile for Bitcoin ETFs, with 9 out of the 18 trading days so far being outflow days amid macroeconomic uncertainty. And so here to discuss the state of the market, we've got Chris Klein, Bitcoin IRE co-founder and COO. Chris, good to have you back on with us. So what's driven this rush of investor activity in Bitcoin as you've been tracing?
Yeah, absolutely. It's good to see you again, by the way. I'm sorry I'm not in studio with you today.
All good, all good. We appreciate it.
I think there's a lot of things that are happening. Obviously, this is a choppy market. I do feel like we're in a tale of two cities. You see it's kind of doom and gloom and bearish sentiment in the traditional markets. But Bitcoin and crypto in general have a very passionate base, which is showing a much more bullish sentiment at this time. So if you go from CNBC or Yahoo Finance and then over to Twitter, you see two different worlds happening. And this is driven by a few things. You've got the Federal Reserve making some announcements last week, opening more doors of regulation. You have the halving effect that's coming closer and closer. We've talked about that in August or September. And then you've got these institutional plays. You've got a lot of inflows. A lot of folks are trying to replicate or find that new edge on the MicroStrategy play that's happened over the last couple of years.
And so we've been trying to break down some of the charting for our viewers as well, some of the key technical levels and some other psychological levels as well. That 100K is, of course, one of the larger psychological levels to get back to, but it seems like 95K is perhaps one of the more significant interim technical levels that we've been tracking. I wonder, in your assessment for Bitcoin, what are some of your targets that you're tracking and what will drive those moves?
Yeah, I think you're absolutely right that 100 is a big psychological barrier. You saw when we burst through it late last year, then it ran all the way to all-time highs at 108. I just was recalling when I flew home from seeing you last month, we were posting our worst quarter in a few years, and there was a lot of buying opportunities in those dips, getting down sometimes into the 75, 76 range. And so that had some impacts on buyer sentiment as well. For me, I'm watching 3 to 6 months out. Where are we going to end end the year is a good question. I'm getting that a lot. I have clients that are very ambitious and have extremely high numbers and goals, to you get to like Tom Lee has called from Fundstrat, has called for about 250,000 Bitcoin at the end of this year. I think that with the monetary supply, the global M2 supply correlation, it's not too crazy to see us somewhere between 150 to 180,000 as we close out this year in 2025 for the Bitcoin price.
What would be the core driver to get us there, though?
Obviously, monetary supply, a liquidity market where we're pumping more fiat currency into the marketplace always helps these types of assets, risk-bearing assets. Then secondarily, you have the impact of halving. It's usually within 450 to 500 days where you start to really see that the effect of what happened last April. And then you add in this institutional play. And for me, it's the delta, that tale of two cities between traditional markets and crypto markets. When folks are looking for, I wouldn't call it hedges, but more diversification in this environment, Bitcoin is starting to show a little bit more of that shine and luster than it has over the last few months.
And so with that in mind, for investors out there that are trying to figure out if they've already missed the key opportunity to buy into Bitcoin, is this still presenting opportunity? Are there more perhaps choppy signals on the other side of that ahead?
Well, volatility is part and parcel for Bitcoin overall. I've been about a decade into this. I had no gray hair when I started it, and that's the volatility coming out. But I think the key to the question is it too late or too early? And the answer is it's never too late or too early to get into the cryptocurrency space. One of my favorite memes I always see is the line of people that'll buy Bitcoin at 110,000 is a mile long, and the line for when it's at 76 is short. And you hear, oh, I'm glad I didn't buy it when it was down, and oh, I missed out when it was up. And one of the things that any advisor will tell you in any traditional or crypto asset is dollar cost average. It takes the emotion out of it. And when you're living in a volatile market space, whether it's in traditional equities or in cryptocurrency, dollar cost averaging really makes it very simple for you to have an investment strategy that you don't go all in or freak out as you start entering into this space.
Just lastly, while we have you here, Chris, beyond Bitcoin, Solana getting some attention. NASDAQ listed firm DeFi Development looking to raise $1 billion to boost its Solana treasury. Is Solana a solid altcoin investment for other investors?
Well, actually, interesting note, they already raised about $500 million, so they're halfway there in the last week or so. And what's interesting is this is people taking the page of Michael Saylor and MicroStrategy. 21 Capital's doing it as well. Traditional institutions are always trying to find that edge, just like emerging markets. And this is an emerging market where they see this treasury fund that can be built, and you see funds flowing into it. Solana's a great layer 2 that has a lot of competition out there. There are some folks calling for it to possibly flip Ethereum. It also has a very passionate base. One of the things you'll find as you do your research in cryptocurrency is that each of these altcoins has a very passionate base around it, be it XRP, Ethereum, Solana, or others. I do know that Solana is a very popular coin as an alt in our platform. We're at about 14 billion in assets under custody now. And I would say take the Ethereum and the Bitcoin off the table, the other 40%. Solana is definitely a leader in the retirement savers as a potential. It also has a staking mechanism to it. So it's a cryptocurrency that you can make yield off of. And hopefully when I see you again next month, I'll be here to announce that our staking program has gone live as well. That's a beast that's going to come to life in a lot of institutions. That's going to really bring some excitement around the space.
All right, I hope to be talking about this. Just lastly, while we have you, you mentioned something key, which is the sentiment around Solana versus that of some of the other coins. Is this impacting Ethereum's ability to actually bring forward what was touted as the flippening and that not coming to fruition at this juncture?
Yeah, if you went back a couple years, there was the great flippening conversation, and even Ripple has had, or XRP, sorry, has had a conversation about flipping and moving. It's always about getting those top 5 spots. I think what you're seeing is that passionate base around it. I don't necessarily call it a zero-sum game in this space. There are particular use cases for each of them. They have their strengths, they have their weaknesses. It's about speed, uptime, and network driving, and you're gonna see where developers go. Where do they build the next thing on which chain? But it's not a zero-sum game. There's room in this space for everybody.
Chris, great to see you. Thanks so much.
Thanks for having me.
Coming up, why multiple states are investigating a federal student loan provider. That's next on Wealth. It's Housing Week on Wealth, and we have the Home Buyer's Playbook with everything that you need to know about every step of the home buying process, from the planning stages to the closing process to the first year of home ownership. And today, we're diving deep into the process of making an offer on a home. Joining me now, we've got Melanie Atkinson, realtor with Compass. Great to have you here with us. So what do prospective home buyers need to know about working with a realtor? Walk us through their role throughout the home buying process.
Yeah, well, we know that 88% of home buyers use a realtor because the process can be confusing for people. So what they need to know is that their realtor is going to work with them to be their home buying project manager. They're going to help them get access to houses. They're going to help them do research on the homes, even off-market listings. They're going to help put the team together that will help them through the home buying process, like lenders, insurance agents, inspectors. They're also going to help you understand your contract and negotiate it. And they're going to navigate the inspection and repairs process, everything that needs to be done to get you to the closing table.
So explain how a buyer-broker agreement works.
Yeah, so that's been a big change in our industry in the last year. So buyers are now required to sign a buyer-broker agreement with their broker agent that specifies the duties of the buyer-broker. It also specifies compensation. And a lot of buyers can get nervous about signing a contract that says they have to compensate their buyer's agent a certain amount. But a good agent will be able to use that as part of the negotiation of the house itself. It is not unusual for sellers to still contribute to the buyer's agent compensation. And in Florida, where I work, we still have a lot of sellers that are outwardly offering a buyer's agent compensation. So we don't want buyers to be afraid of it, but we want you to get an agent that understands it and can explain it to you and negotiate it properly.
So what do prospective home buyers need to do as they get ready to make an offer?
Oh, sorry, I thought you had more of the question. So whenever they're ready to make an offer, they want to make sure that they have their pre-approval letter ready. They want to make sure that they're going over all of the disclosures that the seller is providing. So homeowners association, condo associations, they definitely do not want to get stuck in a situation where there's some special assessment that they didn't know about. So check those disclosures. You also want to have your agent look at recent sales and pendings so you can make an educated offer. And then really important is to consider all the costs of homeownership from a monthly budget perspective. Don't just look at your mortgage payment. Make sure you're paying attention to insurances and extra homeowners association fees and, of course, taxes.
Now, you also have some tips to help prospective home buyers and get their offers selected. What are those tips?
Yeah, so it's not all about money all the time. Obviously, that's the best way to get your offer to stand out is to offer more. But really finding out what the seller's motivation is. Maybe they need a long or short closing. Maybe they need a lease back where they are getting out of the house over a month and allows them an easier transition. There's a lot of different things that you can do with your lender. You can have the lender call the agent and the listing agent and explain that you are a well-qualified buyer, so the sellers aren't nervous about your ability to get the loan. One thing that we do here in Florida is we have shorter contingency periods, which tightens up the contract and makes it more desirable.
I was going to wager a guess that you were in Florida based on the Tampa Bay Buccaneers paraphernalia behind you as well.
Yes, Lightning and Tampa Bay Buccaneers.
Yes, yes, indeed. And so all those things considered, as you're looking at the Florida market versus what we've seen perhaps down payments more broadly on an aggregate scale, you know, what is the comparison that you're seeing and how hot is the market down there?
Well, the market has definitely cooled off a little bit from the COVID years. It was crazy here in Florida during the COVID years. So we are more working towards a balanced market and even a seller's market, or I'm sorry, a buyer's market in some situations, especially condos. We have a lot of inventory of condos. It's a very complicated situation with the condo market down here. But in general, we don't have the same amount of people coming down here. It doesn't mean that the market is distressed. It just means that it's slowed down and it is a little bit more balanced, which is really great for buyers because they have a lot more leverage now than they used to a couple years ago.
Melanie, thanks so much for taking the time here and breaking down some of the expert tips for folks who are getting out there and perhaps doing some shopping this weekend. Appreciate it.
You're welcome. Thank you.
The Higher Education Loan Authority of the state of Missouri, or MOHELA, which handles the federal student loans of 6.8 million borrowers, is under investigation by multiple state attorneys general over alleged mismanagement. Here with more on this report, we've got Jordan Weissman. Jordan, what do we know about the allegations against the firm?
We've only got kind of the vague outlines of what's being investigated right now, but this kind of thing could be a very big deal. For context, several years ago, a very large state attorney's general investigation ended up essentially bringing down Navient, which was then the biggest student loan servicer in the industry. And of course, everyone who has had a student loan has had to deal with a servicer, has probably at some point had some sort of customer service frustration with them. Mohila currently gets the worst marks on customer service and on a lot of other performance measures of any of the current servicers in the industry. And what I'm told is that the states are investigating a lot of issues that involved the return to repayment after the pause. When the Biden administration began collecting monthly payments again in 2023, things like botched billing, late bills, miscalculated payments, messed up paperwork, things along those lines. Also, maybe some things related to the public service loan forgiveness. Some of this investigation may also parallel the several class action lawsuits that have been filed against Mohila in recent years by borrowers.
So as Mohila is under investigation, what's at stake here for borrowers?
Well, could be quite a lot. I mean, if, Mohila gets in trouble at the states and there's some sort of legal action, they could be getting money returned to them. If this gets really bad for Mohila, who knows? There might be a possibility it gets driven out of the industry. But that's real, like Navient was. But that's really kind of getting a few steps ahead. This is still a investigation in its kind of early middle stages, as far as I understand. We don't know exactly where this will go. And I've also heard that there is some concern that the firings at the Department of Education could end up slowing down any investigative efforts. And that's because a lot of those requests for information that the state attorneys general are putting in have to be processed by teams at the Department of Education for legal reasons. And those teams are all gone. They've been let go. Right. So the people who would sort of facilitate these investigations on behalf of the federal government, they're not around. It's not clear what's going to happen to them now.
I want to squeeze this last story in. Aside from Mohila, the Department of Education is planning to enter defaulted student loans into collections 1 week from now. What should borrowers know ahead of that deadline?
Well, if you have a defaulted loan and you've been contacted, you should definitely look into potentially rehabbing that loan. If you have not done that before, there is a chance to get current on your payments again. It requires making essentially 9 on-time continuous payments. It's supposed to be calculated at an affordable amount of your income. So don't just sit on it. Don't let the bill collectors show up if you have defaulted. Go seek help. There are organizations that also are willing to give advice on how to handle all of this thing. There are people out there who are happy to help hold your hand.
Jordan, thank you so much. Really appreciate it.
Thanks for having me on.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close.